exist, there's many regulations. Regulations are very costly to uphold, which means that it's very hard to raise capital in the short term to make sure you're being able to follow all these regulations and allocate raise capital. Even if you can IPO, in many developing countries, for example, people don't have that much disposable income, so there's not that much of a retail culture as well. So it's hard to raise money even if you do IPO. But thirdly, alternatives are far worse. For alternatives like hedge funds, for example, have much shorter time horizons because you're more able to, because you invest more in shorter term markets like the stock market, compared to PE firms that are not public firms who are not always disclosing like quarterly earnings immediately, which means they're more capable of doing things like investing in the long term. So alternative forms of funding are far more risky and far more short termist. For all these reasons, for both sides.
Thank you, Speaker, for the institution. I was called on the leader of the opposition, but in the case of opposition. Here.
It's a pretty strange thing for these firms to do, right? Put all of their eggs in one basket. We all know that investors shouldn't do that. So the burning question to this company bench is, why are private equity firms doing that? And the answer is simple. They crave control. The reason they specialize in certain industries is because they control the competition within those industries. They can lobby governments to have more favorable regulations to make sure their investment is more profitable than if they just diversified their funds. And this is an insidious kind of control, and one that we obviously oppose. 3 things in the speech. First of all, some setup. Second of all, 2 arguments. First of all, on setup. This is pretty brief, which is what we imagine the alternative to this kind of specialization being. We think it's probably a diverse set of private equity firms operating within these industries as opposed to single firms specializing within them. That is, firms pretty much want stakes in a variety of different industries, so you see, to the extent they're not being crowded out by single specialized firms, there'll be a number of private equity firms taking stock in a bunch of different companies here. First argument then, explaining why this monopolizes private sector investment within the areas that they're investing in. The first thing to explain here is that private equity firms tend to have a lot of money to play with, and this is pretty intuitive. They need to cushion the risk they might take, they need to buy large shares of companies, and because it is generally seen as a pretty good investment, a lot of people are willing to give their money to private equity firms. Finally, empirically, we know for a fact that private equity firms tend to be pretty large. The second thing to explain is this means that when you specialize in a certain industry or sector as a private equity firm, they take up a meaningful share of the market within that sector. This is for 2 reasons. First of all, they either go about this control by taking many controlling or at least large stakes in large amounts of companies within this single industry to hedge risk, or second of all, get a lot of shares or a lot of equity in a single successful firm within that sector, then kind of undermine the competition of all the other companies. Secondly, to the extent you don't believe that every single private equity firm is large enough to specialize and take controlling shares of the sector, they just operate on a sliding scale of control. Like if you're a smaller firm, you just specialize in a smaller sector within the market, which means you still do gain the level of control over that industry. Third of all, other equity firms don't enter these sectors because first of all, they want their own region to dominate and control and get power over, and second of all, there's only so much equity to go around. The result of that mechanization is that specialization means there's less competition within these sectors and they're controlled by private equity firms. 2 impacts to this. First of all, this reduces the return to investors on private investment, and this is pretty simple. A world in which simple private equity firms specialize within sectors, they have less competition over the rates of return for their investments. This means they charge users higher fees and don't offer as competitive rates, which means people who give their money to private equity make less cash. But second of all, they have less pressure to make suitable investments because once again, they don't need to provide a greater return than any of their competitors. The result of that is that people who invest in private equity make less money when there is more monopolization within that sector. But the second and higher order impact to this claim is this provides the ability for private equity firms to lobby regulation of both industries and governments that they gain control over. Why is this the case? First of all, this provides them the incentive to do that kind of lobbying in a way that doesn't exist in the alternative. Because when private equity firms have their eggs in many, many baskets, they never have any reason to put a bunch of cash into lobbying a government to loosen a regulation over a certain industry. But second of all, they uniquely have the capacity when a single or a few private equity firms have this level of control. Because first of all, they can use their own funds to do kind of lobbying towards the government, funds that don't exist for private equity firms don't do this investment. But second of all, they can also control and influence the companies that they have shares in to use their own money to do this kind of lobbying. Notice this is asymmetric, and companies don't do this in the absence of these hedge funds because you need a single controlling entity to make sure no one plays foul, which doesn't provide their share of funding to the lobbying, which is why you need an overarching owner for this kind of lobbying to happen. What does this impact look like? It is, first of all, on an industrial level, companies and hedge funds and industry funds lobbying the government to reduce regulation. This is medicine prices being higher because the government is unwilling to introduce price caps. This is insurance not improving people's applications because there is insufficient government oversight. This is diabolical. This is awful and this kills people. Obviously something that we all regret. But second of all, on a national level and a regional level, this looks like governments themselves being lobbied, especially smaller and developing governments, on the kinds of restrictions they put in place on industry. This is making sure that wages are lower than they should be because it means it's better for those private equity firms and they get more money. It looks like, second of all, there being less environmental regulation on things like mining to make sure the bottom line of these private equity firms isn't hurt. The result of this is, when you put all of your eggs in one basket, you do everything in your power to make sure that they are safe. So you control the government, you control industries, and things get worse. Close it.
So there's so much money in private markets now that if the market was inefficient because there was only one fund in the sector and they were overcharging their customers, someone else would see an opportunity to make money by undercutting and enter that market.
But I thought of that and provided the mechanization why that isn't true, because every private equity firm wants to have their own control over a sector, and you get more money when you control a sector than competing with a different company, because you can do the kind of lobbying that we discussed. And notice, as I explained before, this doesn't have to be one private equity firm or two private equity firms controlling medicine. It can just be the specialized production of certain drugs, which is how this kind of mechanism takes place. Second argument, let's explain why the distribution of capital gets worse on the whole. The first thing and the main premise to explain here is that this flocks capital to a few premium industries. And the reason for this is that when private equity firms put all of their money into a single industry, they want to reduce risk as much as possible. Because that industry is a little bit wobbly, they lose all their money, they collapse, and that's very bad for them. This means they choose industries that are already quite low risk, and thus are unlikely to get them a loss. What is the impact of this? The first impact is that it drains financing and money away from slightly less safe industries. And note, I'm not talking about super risky industries that means people will lose all of their money. These are just industries that instead of having a 0% risk to the equity firms, have a 0.1 or 1% risk to the equity firms. And the reason that's important is twofold. First of all, it means developing industries don't now just have less money than they otherwise would have if private equity firms instead diversify the money they had across many, many industries. And this means tech firms, medicine firms, and other critical industries now don't have the access to private capital that they need to do things like invest in infrastructure or pay their employees to ensure that there is sufficient competition within the industries or these kinds of products or innovations are produced in the first place. But second of all, it means many other sectors and industries and firms lack the management expertise that private equity uniquely provides. Because the reason it is good to have a private equity firm owning some of your shares is that they are very, very good at running companies. Like, that is their thing. And this means that when they own some of your shares, they provide advice and they provide useful information, which means all of these firms operate in a way that is more efficient and more effective. Obviously, this has a huge scale of impact because it impacts many companies over many sectors. But the second impact of the centralization of money is that it makes equity firms far more vulnerable to shocks. And the intuition here is simple. When you specialize in a single sector, if that sector goes poorly, things go poorly for you. And I noted before that the kinds of things they invest in are especially low risk. But despite this low risk, shocks still do happen. Like global pandemics that no one predicts do things like shut down transport and collapse firms. The change in mineral demands because of increases in innovation and technology do things like restructure the market in ways no one can predict. And that is bad because first of all, investors lose a lot of money very quickly and that's bad for them. But second of all, when private equity firms collapse, industries lose huge chunks of money at once. And this means firms fail and services aren't provided. It is a bad idea to have centralization of private equity.
I thank that speaker for that fine speech. Now I'd like to call upon the Deputy Prime Minister to review the case for side government. Here.
saber it off, so my stopwatch isn't going off. Okay. 2 points in my speech. First, areas experiencing underinvestment, and second, regulating bad behavior by large PE firms like Blackstone, Carlyle, and KKR. First, on areas experiencing underinvestment. I want to first weigh this argument heavily. Investment matters more than arguments they name, like competition and monopolization within particular sectors. There are a number of reasons for this. First, the effects of monopolization are substantially less certain. Opening opposition just says monopolization reduces the return on investment in sectors. But if there is a sector that is extremely underinvested in, or a geography that lacks large amounts of capital, then you often want firms that are larger. Why? Larger firms that face less competition have lower risk, meaning they're able to attract other investors as well. For example, they have a shorter timeline to doing things like attracting retail investors. They're also able to access economies of scale. Fixed costs are extremely high in new sectors. You have to pay really large rent, but the landlord doesn't trust that you can keep your factory running. As a consequence, you need as much production as possible to spread these fixed costs across multiple units, meaning firms actually benefit from scale. So the effects of competition are uncertain, while the effects of having capital, creating jobs, ensuring your sector survives are certain. Second, in the absence of investment, natural monopolies often form anyway. The reason why is the only firms that are able to survive in underinvested sectors are firms that are somehow able to draw capital. For example, because they have connection to government regulators. These are situations where they draw some amount of capital and end up becoming bloated firms that are natural monopolies. But these are different than PE monopolies because PE cares about managing their firms well because they do not want consumers to be turned off from buying their product. In contrast, if you're a bloated firm that only exists because of things like government subsidies, you operate incredibly inefficiently. So having investment is the most important issue in this debate. Their only attempt is basically competition reduces returns on investment, which might lower overall investment. But here's our argument. The specific sectors and geographies like EM that need investment the most often go wholesale ignored by large PE firms like Blackstone, KKR, and Bain Capital. By the way, Bain Capital Healthcare is presumably a subsidiary of Bain Capital, which is a diversified PE firm. First, as PE firms grow, their risk tolerance decreases. Large PE firms have more investors that put pressure on them. They have an existing substantial flow of profit, so they have less reason to take risk. And crucially, there's a trend of PE firms partnering with asset management firms, for example BlackRock, to create retail vehicles. And retail investors are less likely to want substantial EM portfolios. Second, there is a limited number of broad and diversified PE firms because being diversified is incredibly fucking capital intensive. That means you don't have PE investment going into large numbers of underinvested geographies. And here's the problem. You don't have other kinds of investment as well. Poor countries have extremely low savings rates, so they don't have easy ways to get access to investment. And PE investment is often better because the time horizons of PE firms are much larger than EM portfolios held by hedge funds that just invest in incredibly big portions of correlated markets and then sell their stocks the moment they have a potential of going down. These time horizons being large is critical because it's what used for developing countries to have firms that build factories and to build infrastructure. Critically, a lot of this is government investment. It's things like PE firms privatizing airports. Regardless of how these airports are managed, you need capital in order to sustain these airports, and without airports, you don't have business investment in other sectors because travel within your country is substantially harder. Why is this capital likely to be used well? First, it is easier for regulators to handle these firms. And this doesn't really clash their claim on lobbying the government to loosen regulation of the industry, because what we care about in a lot of these cases is regulation of PE firms. But financial regulatory bodies often have substantial access to lobbying from big PE firms. Big PE firms are the ones whose ex-employees turn to financial regulators. We are fine for these industries to be deregulated. Governments often have excessive red tape over industries like the healthcare industry that drive up costs of living for average consumers. But second, independent of regulators, they have incentives for their infrastructure projects and airports in these new markets to go well, because as Liz pointed out, they don't really have the capacity to engage in things like asset stripping. These are often consumers who hate them. Like for example, when Adani ran airports in Kenya poorly, Kenyan protesters literally pushed Adani out of the country. This is not an option these firms have. So we have large amounts of capital. Now I want to address their claim on the effects of competition within the industry. Why is it likely that they do not end up controlling and undermining a big portion or a single sector? First, the presence of potential capital drives more firms into the sector who view the sector as profitable. Because if there's some PE capital, then a firm thinks, hey, this sector has some alpha, so it makes sense for me to try to set up in this sector. And a single PE firm doesn't have enough capital to buy up every single firm in a sector. It is especially true because sectors are often broad. They're like, oh, you can control the specialized production of certain drugs. But individual businesses want to diversify as they grow. And PE firms want 7-year growth potential for their businesses, meaning they want to invest in a pharmaceutical firm, not a firm that produces a single drug. And in that context, you can't have a single PE firm wanting to control every sector because there's a limited number of a sector where there is mismanagement in that sector. Then they say concentrate, then they say these firms will be crazy risk averse because there is risk to the whole sector collapsing. They're confusing firm risk and sectoral risk. PE firms are unlikely to be absurdly low risk because the whole point, the way they can compete with large PE firms is by having relatively high risk tolerance. If they're extremely low risk, your returns go down, and critically, they are unlikely to be extremely low risk because a risky firm doesn't create systemic risk in the entire sector, which causes the sector to collapse. Like one firm operating riskily doesn't increase systemic risk throughout the sector, meaning the diversification argument doesn't actually explain why they push these firms to bad management practices and low risk. You don't even have PE investment on their side of the house, and this is the largest impact so far. Second, I want to talk about the practices of large PE firms. Here's the argument we make. In context where large PE firms do enter the market, the lack of competition drives bad practices. And this is the problem in healthcare. When Carlyle buys the Manocare chain, it leaves it with $5 billion in new debt, extracts $6.1 billion by buying land and buildings, and caused Mano to declare bankruptcy. Yeah.
I don't get how your case works. PE is so competitive, you can't do asset splitting because other companies will enter in, compete you out, your shitty run company.
Yeah, but like that sectoral PE being competitive. Large PE firms don't face competition. Like, that's the whole point. Like, there's a couple of firms, like Carlyle, KKR, and Blackstone, that don't face competition, which is why they have the capacity to do asset stripping. Like, I'm really confused by that argument. How does a PE firm profit by engaging in asset stripping? Usually in one of two ways. One, it has a large number of investments in other areas. So, for example, you have big investments in real estate, big investments in construction, big investments in healthcare. In that context, PE firms often want cash flows from their investments rather than profits. They don't care about the long-term profits they get. They want immediate cash flows which they can invest in the sector they think is more profitable. This is why PE firms engage in asset stripping despite having 7-year time horizons. And this is why Carlyle drives the healthcare sector to the ground. Second, large PE firms face less competition. As Guy points out, experiencing competition from specialized PE firms is what holds them accountable by preventing them from running firms to the ground and making them substantially unproductive. And third, sometimes PE firms have competing investments in one sector. Apollo is more likely to have that than a single small specialized PE firm which can face competition, and that means it drives other firms down the ground, flipping their competition argument as well. So competition is also worse on their side. Propose.
I think that's figured out my speech, and I'll call the yellow here.
If you're unfamiliar with it by now, after this debate, go look at Mitt Romney's political record when it comes to healthcare costs at a variety of levels in the United States, and then consider that he's the substantial owner of, yes, a subsidiary, which is a different company, and is in fact how many of these specialized types of PE firms get set up as initially subsidiaries of larger private equity firms. Consider that he's the owner and large operator of a private equity firm that specializes exclusively in healthcare products in America, has an enormous incentive politically to keep it expensive. That is the reality that this government bench stands behind. When you have incredibly important industries that could be stable, that could be invested in, this creates an enormous set of perverse incentives. Firstly, what are the alternatives, and second, and why this is harmful to these sectors? First one, the alternatives. Your intuition should go really hard against this bench when they tell you that there are insufficient other forms of investment in these areas. Firstly, there are traditional private equity firms. They give a variety of examples of ordinary private equity firms going into, yes, sometimes emerging markets, yes, sometimes emerging sets of new technology. They have an obvious incentive to do so for the reason that they still have to compete with each other, they still have to provide returns, and unrealized returns are a better source of returns than just them exclusively trying to extract more returns out of where you're already investing. There are other forms of institutional investments that are far better behaved and far more stable, like large retirement and pension funds, like hedge funds, that all compete in terms of each other. Firstly, on the emerging markets, which is a funny way of saying developing world. Firstly, this is not overwhelmingly where the types of geographically specific types of private equity firms operate. The ones that exist in the status quo are, I believe, largely to do with small and medium enterprises in places like Europe and places like North America. And the reason for that is, when you invest in a really specific sector or a really specific geography, you want to do it in a way that is relatively stable, because that always will carry a higher risk than investing in a more broad or general sense. So they tend to go for those areas. Secondly, most large enterprises chance can occur. So even if this is the thing that drives enormous amounts of PE attention into developing markets, that's a problem. Because lobbying is much easier. Sometimes it's actually called bribery, and it's incredibly easy to do. Second, because they have the worst consumer-facing protections, which given that a lot of these things operate from small and medium enterprises, and they operate in healthcare, and they operate in insurance, that type of consumer protection and market protection is incredibly important and lacking in this context. Thirdly, emerging industries, they have emerging industries where the impact of early monopolization distorts the development of those industries in a far greater sense than if those industries are more mature. Third, these contexts are much better served by the existing set of investment products that already specialize in a large amount of these markets, largely publicly, but sometimes in those private markets as well, like traditional private equity or like a variety of other investment mechanisms that I've just said. Oftentimes, domestic pension funds are huge sources of capital for those types of enterprises. Second problem that they identify with apparently no alternatives. That's PE firms behaving poorly. And the first is just to point out that empirically a lot of the specialized private equity firms come from existing private equity firms and perhaps split off more distinctly later, but at the very least operate as a distinct entity. Now, you should believe that not just empirically, but for two reasons. Firstly, the startup cost of running a private equity firm is incredibly high. You have to buy up a bunch of stuff. You have to have enormous startup capital costs. That often comes from the existing capital coffers of already existing investors. Second, a lot of time you need the management expertise, people who work in that industry already. Where are those people? They're either fresh graduates or they work in existing private equity firms, which explains why they tend to come from there. Well, if that is true, nothing ever happens because they behave in the same first way as parent companies that they come from. Second, they never explain why private equity firms, just because they are large, don't both compete with each other. And thirdly, they don't explain, in fact, I think give examples of instances where things like public backlash or other forces that operate in the market do also contain the behavior of these private equity firms. Let's definitely explain why it's harmful to sectors. Closing. Opening.
I gave you a bunch of reasons why PE firms don't want to diversify into emerging markets if they are established PE firms. I also explained why hedge funds...
Yeah, I mean, he gave me an example of a private equity firm diversifying into an emerging market, and equally, we give you structural reasons why having to spend unrealized gains, and in a context where there's enormous population growth and enormous GDP growth compared to a set of slowing economies, I do not understand why, in the medium to long term, there's not sufficient existing private equity and other forms of institutional investment interest in the developing world. Like, insane argument. Second, it's really harmful to these sectors, and the simple intuition is that private equity firms looking for a profit, either in sale or in operation, and specialized PE firms have to do it worse because the sector is the only basket in which their eggs are. Firstly, what's particularly bad about the way that they behave? They are firstly way more politically active than a traditional private equity firms or other forms of institutional investment. Firstly, as many of them are operated or staffed or invested by politicians. And that is for the reason that it's far easier when you invest in industries like insurance or construction for politicians to enter into those types of investments, to invest in those firms, or even to participate in operating them. Because the thing that gives you an advantage in that respect is having insider information about the way that those things are regulated now and are likely to be regulated into the future, which explains why in things like insurance or construction or healthcare, having that insider information is incredibly important. Second, they only have one thing to do. They can have officials with messaging about why they should change regulation. They can do all of those things rather than having to diversify the types of lobbying power. And yes, I know that BlackRock do lobbying, that's fine. They have to do it across the plurality of markets that they're invested in and a plurality of sectors. That is better than carving out a single portion of the market where you can influence enormous amount of control. Second, they behave worse in respect to these companies. Firstly, because they cannot hedge that risk with anything else. They constantly need to be extracting as much value from them as possible. And they did it they're not that short-termist. Firstly, that's not always true. There are many types of bias, things like healthcare assets, things like equipment, things like existing practices. So you can, in fact, participate in asset stripping even if you operate in a specific way. Second, many of those harms still come with the ongoing operation of them. Like raising healthcare costs at the one GP clinic in a town is a form of harm that comes with the ongoing ownership and operation by private equity. Third, they have enormous incentives to act in monopolistic ways by merging and moving around assets merging those companies. One, in small but impactful ways. For instance, merging all of the clinics in one side of a city to a single healthcare enterprise with multiple different locations, meaning that you can jack up prices for a consultation, do whatever you want. Or just in ways that are larger, but H trust doesn't always catch, Zen's trust can be fairly inefficient. And fourthly, they're more prone to instability. They're prone to collapse because they put all their eggs in one basket. They're smaller than the large firms from which they come. What's the impact of all that? Firstly, the public-facing impact of this is enormous. It is in consumers, it is in their insurance costs, it's in their healthcare costs, it's in the products that they buy. It's secondly bad for competition. It's bad for new entrants because when they enter the kill zone, if you're a private equity firm that has an enormous stake in that market, your incentive is to either buy them or kill off their business as quickly as possible. And fourthly, it introduces huge inefficiency when firms go under. They're
here.
First extension on allocative efficiency. The trade-off in this debate is that on one side, you give your money to a big firm, they then select that internally within that firm, which sector and which geography is likely to be the most productive. On the other side, you end up with a situation where there's lots of market actors deciding on what sector and what geography they want to invest in by what allocation they make to particular private equity firms. What I'm going to explain is that the market is far better than a large private equity firm at determining what is likely to be a more protected geography and sector, leading to more allocative efficiency, more production, making everyone richer. Why is the market likely to be a better decider? First of all, a lot of these big private equity guys get these huge cults of personality. They end up super arrogant, everyone worships them, no one questions them, they're going to fire you if you do, and that makes them actually quite bad at decision making. Secondly, there's management incentives that don't actually align with productivity. That looks like the fact that you often don't want to admit that you had made a mistake, so you continue down the same investment strategy even when it has become unprofitable. Because if you admit it, you're going to get fired, and you're at least going to hang on by trying to tell the management board that no, I didn't screw up, this is going to be efficient. Secondly, there's entrenchment bias, because you want to make investments that make you as a manager more and more valuable. So you don't invest in what's most productive, but you invest in the thing that you have the most specialized knowledge of, which therefore makes you the most difficult to fire. Yes?
Large private equity firms offer specialized investment products, meaning this extension is symmetric.
No, because in a lot of cases you're making broad-based allocations to those funds, and that means that and also even if you're making particular fund-based decisions, you're still not putting as much sectoral lock into that because you've given it to the fund. Thirdly, you get many more actors doing it now. Many more actors are making the decision, and that means that you get a kind of wisdom of crowds thing. Fourthly, you're focused specifically on allocation, because things like hedge funds, things like pension funds, things like big institutional family offices are focused very specifically on allocation, whereas the focus of these funds is split between allocation and actual management, which means that they're less efficient at it. Fifthly, turnover is very fast, which means that you're insulated from the future to a high degree. And sixthly, you're exposed to the benefits because you get big bonuses, but you don't then have to pay that back if you fail. What you do is you lose your job, but the time horizons of these people are very short anyway. What is the impact of this? It means that we get more productive efficiency. We make more stuff. I know this seems abstract, but it's not. It means we get more things. It means that we get better wages, higher quality of life, less poverty, more taxation revenue to be able to pay for things. What is the weighing on this? First, private markets are growing rapidly, so it's a huge source of allocative efficiency. Secondly, private markets are doing a lot of the most productive investments, for instance, in small startup firms. And thirdly, it weighs over opening half. When concerned with specific industries, we explain why overall the entire economy gets more productive. Second argument, why do we get better incentives for investment? The first thing I want to note here is that you now expose these firms to the externalities to a far greater degree. I'm going to first talk about geography and then sectorally based firms. First of all, geographically, if you do things that have large externalities of those firms, that then means and externalities often are geographically located. That's to say that if I do environmental damage and people leave this area, that means that my other firms are going to suffer. If I turf people out of their houses, there's not going to be enough consumer demand for my investment here. And that might be a worthwhile trade-off if I only owned one firm, because the benefit of that act might be large enough to get the externality. If I own a large number of firms in that area, then I'm more exposed to that externality, so I'm unlikely to do things that have huge externalities on people. Secondly, within a sector, you're more exposed to the cost of that. And this is a better explanation of asset stripping than opening government, who says, well, you could do other things. I'm going to explain this now much more of an active harm of asset stripping. The first is that you're now exposed to the cost of those assets, because when you asset strip to a high degree, that lowers the cost of those assets on the market, which also then lowers the value of your private equity firm. So if there's any kind of independent analysis of the overall value of your private equity firm, you've just lowered it. You've also lowered your borrowing capacity, because the value of the assets that you own is also lower. And if you do end up needing to sell off those assets because your venture failed, not through asset stripping, but just genuinely because your venture fails, you then are less able to get out of it because the value of the underlying assets are lower, which more exposes you to risk. So this explains why there's more internalized problems with asset stripping now, so you're less likely to do the asset stripping. What is the weighing on this extension about externalities? The rest of the debate is about, well, private equity gets more efficient, and then there is, to be fair, a pretty intuitive mechanism that's like more efficient investment is better for people, and I think that's true, but our mechanism for helping people is a lot more direct. Our mechanism is the externalities from those businesses that directly impact people get less. Next extension, on stability. Opening government is like, well, these firms are likely to be smaller on net, and therefore they can't deal with as much volatility, and therefore they're going to want the stability of their firms more, which is an argument on the vector of size, but not specialization. And yes, size and specialization might be correlated, but they're not the same thing. My argument would be directly about the specialization on sectors and geography of those firms to explain why it is that they want more stability. The first thing to establish is why they want volatility in the first place. First of all, because they've often done highly leveraged buyouts, which means that they need to make a lot of money back in order to pay it back. And secondly, because the bet is asymmetric from them, because the benefit is very large, but they insulate themselves on the downside with bankruptcy law, which means that they're not fully exposed to the losses. And how do they deal with this risk? Then they diversify across a high number of firms that they're invested in. But that doesn't work on our side, because shocks are correlated by geography and sector. By geography, if there's a downturn in that area, then all of your business is going to struggle. By sector, if there's a downturn in demand for that kind of good, all of your businesses are going to struggle. So that means diversification no longer protects you as much from volatility, because the shocks are correlated between all of your investments. And that means that you're more likely to do things that make your firms sustainable. You're more likely to invest in multiple options for supply chains if one goes down. You're less likely to leverage out that business to such a high degree. What is the benefit of this? First of all, market instability here, and to be clear, I'm not talking about the stability of private equity funds like I was talking about. I'm talking about the stability of the company that's going to sell you a carton of milk tomorrow, and that is far more important, because market instability is consumer goods access instability. That is incredibly bad. Secondly, getting more market stability on our side means that you don't lock out investment. The final impact of this is that you're going to end up with less risk, because it means that you can't have that risk contagion across different sectors and different geographies. Because if some of them go down, then all of a sudden you can't invest in your other investments, and sometimes you then need to sell off other investments, which lowers the asset prices there, which means everyone else loses money, and then it restarts the cycle of the domino effect. But this insulates that within geographies or within sectors, so you don't get as much contagion. Finally, this leads to more efficient pricing of assets. And the reason for this is that there's more funds who are likely to be, there's more funds who are able to compete with each other to price those assets. And yes, they're constrained geographically, but they can grow that geography if there's a sufficiently enough good deal that they think is sufficiently undervalued. So you're going to have multiple firms pricing each asset. That means that the assets are more efficiently and correctly priced. The impact of this is, first of all, people don't get fucked. Like if I'm a founder who starts a business, I should be compensated for that business when it's bought by private equity. So if it's undervalued, that's a principal harm to me. But secondly, if it's too high, it's very bad for the stability of private equity, because it leads to situations where they put in too much money that they're never able to recruit, which means that you get more, which means that the sector as a whole gets less efficient and is less able to put money into good things. We get more efficient market pricing on our side.
I think that's speaker of that fine speech. Member of opposition, the floor is now yours.
Okay, well, ready?
Yeah.
First, a rebuttal on the risk. We think that risk exists more on our side for four main reasons. And notice that this is a rebuttal, it should be considered as positive material. Firstly, they know that they will be bailed out much more. If you are in a certain economy and you know that the government is reliant on you, they will bail out you much more, and so you can afford yourself to be more risky. Secondly, we think there is an overconfident aspect that exists when you are the only one that understands a certain market, and when you have the highest specialization over this market, meaning that you feel like you can be as risky as you want, you feel like you understand the market more, you feel like you can hit the market, and so you are overconfident, so you are risky. Thirdly, because I can change the government, because I can change the political system, I feel like I'm part of the government, I feel like it will be alright, and so I can be risky. But fourthly, it is less critical for them to have the risk and the the fall of certain economies, because they will still be the owners of large things in the countries or in the geographical locations, so they still have the assets. And so if there is a risk, if things go bad, at least they have some property that they can still regain. This means that the chance of a crisis or anything just becomes much bigger on your side, not ours. Two arguments. Firstly, the better ability of companies to develop, and secondly, why specialization leads to why the need one for specialization means that we have basically more specialization. First argument about why there is less ability of companies and to develop. So basically our argument here is that overfitting is very bad and that economies of scale is very, very good. But we will analyze that. So we think that little companies or little things that are invested in need the investment from big private equity firms in order to actually develop, for 5 main reasons. First reason is that we think that we get much more accessibility to professionals in those fields. So for example, if I'm a local startup that wants to advance in the cyber industry, I need the professionals to tell me how to do that. What kind of domains should I buy? How should I set up my website, etc. Those kinds of things are things that happen when I don't go to my local accelerator in Haifa, but I go to the accelerator in Israel or in the big city, etc. Or when there is a big company that will invest in me because they see my potential and ability, which will happen on both worlds. But secondly, the access to the international market, and this is critical because in many different markets there will be an unfair advantage to companies that can go to different kind of companies, to countries, etc. And so when I know that the PE firm of mine can give me the ability to go to the international market, I can access more kinds of market myself as a local firm, and so to advance more. But thirdly, we just think that it lowers massively the marginal production costs, right? We think that when you can do the same thing to many different companies, and when you can say, okay, this is our model on how we start a renting complex in Chicago, this means that you can lower the cost of setting up this business. But third reason is that we think that the international standards are critical for companies that are starting. So if I force the companies in my PE firm to act on the GDPR, this means that on the long term I cut them with lots of hassle that they will need to face, and so I am maybe punching them or hurting them right now, but I am helping them massively after and in the future when they will need it. But the fourth thing, and this is critical, Pano, just investing massively like WUDC can be very bad. Starting, for example, investing in many different things, in many different startups that are not profitable, that cannot be profitable, hurts the local economies much more because they create bad initiatives, because they force people to spend their money, and hurt the market as a whole because more companies are risky. Here we think we prevent that by having more standards that are good. Why is this mutually exclusive and won't happen in the cooperative? We think it is hard to compete with political capture and all of this. And secondly, we think that the amount of professionals and the amount of fees is overall limited, and so it won't happen in the cooperative. Before I weigh that,
The argument on lowering costs explains why sector-specific firms are better because they're able to gain specialized talent and skills rather than applying general principles to the sector. Large PE firms either won't invest for all the reasons I've given you, or they will invest in which they stay
firstly, I think this motion is weird because it says geographical or sectorial, but I think it still falls on our side. I think that the general principles of abiding by the GDPR or how to set up a company or do those things are things that are generic, and you never prove why this hyper-specialization is something that is good. Why is this so important? Firstly, like I said, it is better to not start at all the investment than start investing in bad things. Secondly, we think that when you have an investment that is much more profitable, it's much more important. When you are part of the Adani group, you have much more chance to succeed. And so we think in the end, we get just more investment. Secondly, why we have too much specialization and in an irrational way. This also answers OG directly. Why do we want to specialize when it is not profitable for us? Fourthly, we think there is a huge pressure of individuals inside of PE companies to prove themselves with specialization and special sectors that they know. So if I must start an intern in a PE firm, I want to be good, I show why the economy of Haifa is the most important thing, and this would be my place in the company. This means that I show myself in that way and not in other ways, and so I advertise this much more. But secondly, I want to justify myself to local companies, and so I say that I am the authority in the local niche. This means that I have the interest in the race to the bottom to show that I am the most specialized. And this is horrible, right? Because it means that the companies specialize themselves too much in order to justify why you should choose them and not other companies. But thirdly, it is very hard to criticize specialization, and this is good for the people that want to be hyper-specialized. If you are the only one that understands the local economy of some country, it is hard for other people to say, no, you are wrong. And so you have the interest to be a charlatan, etc. The second reason here is that many of the time the information that is coming is from the local elites, and so it is also inaccurate. Why is this so bad? Firstly, in the comparative, you have much more ability to public criticism of those people, and so to prevent this race to the bottom. But secondly, we think that general rules of thumb are many of the time the thing that is important, because the market is speculative, because we cannot know, because many of the time we decide based on those rules of thumb that are things that historically helped us. We want to have those things for the people in work. So, for all those reasons, opposed.
I think that speaker doesn't mind speech to close the bench, don't we?
Our extensions, then closing opposition, and then the rest of it on opening opposition. Firstly, on our extensions, the first thing we want to do is defend our first extension about allocated efficiency against the POI we hear from opening opposition. The claim they make is that diversified funds allow you to invest in specific sectors by offering funds within that private equity firm that allows you to specialize. Firstly, the firms obviously push investors primarily towards the main fund because that offers them the most agency, which means that they market those very well, substantially better in ways that distort the market. Secondly, you're less likely to invest in the specialized fund of a general firm than a specialized fund on its own, because that specialized fund in a generalized firm doesn't have any of the benefits that we explain of that level of specificity, and if they do, then you don't get any change in space. Thirdly, and I think this is actually most importantly, the motion specifies firms and funds, and this is a fund within a firm. So this rise is including the rise of specialized funds within generalized firms, right? It's about both firms and funds, it's the way you need to read motion. Fourthly, these specialized funds are largely started because they were facing competition from specialized firms. So without specialized firms having existed in the first place, it's unlikely that these big, larger funds like BlackRock start offering those specialized funds in the first place. Fifthly, these funds are often hard to access for a lot of investors. Firstly, they have caps on the amount of investment that can go in them, because larger, bigger funds don't want too much of their money being centralized in that one sector. Their goal is diversification, so they limit the amount of people that can invest in their specialized fund. And secondly, they only offer them to top-end clients as perks after investing large amounts in their generalized fund, when you don't get the same level of benefits as we do. That explains where that extension stands. The next part of our extension that we want to weigh, particularly against open government, is the reason why we give a much better explanation of asset stripping, because I think this is the weakest part of opening opposition's case. Opening opposition says it is their main investment, and therefore they would be unlikely to want to engage in asset stripping of that investment. The problem with this is there's no explanation of why that is the likely decision calculus of specialized PE firms. The question that opening government needs to answer is, does the profit made from management offset the risk associated with it and mean they are more likely to manage than asset strip? Opening opposition provides some plausible reasons why these funds are very risk averse, no response from opening government, so that question remains entirely unanswered. It's also in contradiction with their characterization that suggests they have at least a few different firms, which means that this analysis of their main investment doesn't apply to all of the firms that these specialized private equity funds own. We explain conversely that asset stripping will hurt the value of the assets of their other investments, because remember, the book value of these firms is based on the value of reduces the value of those assets on the balance sheet, which reduces the value of the other firms they own. I want to provide them some new impacts of this, because this team just claims that all these companies go away and that's really bad. Maybe it's good, who knows, but I don't think they really explain this properly. Firstly, it's pro-competition, because it means you get more firms in the market because fewer of them have been deleted. And secondly, it's pro-productivity, for the reason that you get more improvement of companies rather than just entire deletion of them, turning them into better companies, which is better for the market as a whole. Quickly, on closing government, they first, and we'll address the important parts of their case, they claim that they get better access to international markets. The thing that you need to remember is this debate is about both sector-specific specialized firms and geographically specialized firms. And all the reasons they explain why firms that already have dominance in markets are good at spreading internationally are true of sector-specialized firms, which is to say that if you are a US-based green tech energy specialized firm or an energy sector specialized firm, you have the ability to demonstrate an investment model that is success. You have a proven track record of success. You can do all of those things as well. I would make the case that these specialized firms, firstly, would be very good at spreading into international markets. They're very specialized, they have a lot of knowledge. But secondly, they have more experts in that specific area that they can ship out to the new geography they're trying to invest in. And secondly, I would also argue they have the incentive to do this international investment because they can't gain diversification within their own sector to make them want to diversify across different geographies, which also note as a response, but is also a better explanation of opening government's second extension about geographies. They explain that they are more well known, so easier to criticize. Firstly, no one really knows what any private equity firm does or who. The average voter isn't concerned with this, so it's not really important then what voters care. It's more important what regulators think, and I think it's clear that regulators are better able to control specialized firms than public ones for reasons both Matt and opening of the government have already explained. Next, to respond to opening opposition, where I'll spend most of the speech, the first question I want to ask is articulator, how does this impact competition within sectors and geographies? Firstly, opening opposition's argument assumes that specialized firms are the only firms that exist. Even if specialized firms are scared of being in the same sector as other specialized firms, there are still large diversified firms who will come in and outcompete any inefficient specialized firm. Because of their size and their diversification, they're able to move between industries and invest where they spot specialized incumbent firms who are failing. And I'd note here, if you believe that even the most monopolistic, inefficient specialized firms cannot be outcompeted by incumbent diversified firms, you must believe those specialized firms are so efficient that they're better than such a large margin than the status quo, there's still an improvement at the end of the debate. Secondly, they face competition not just from other diversified private equity firms, they face competition from other firms already in that market, which is that the biggest actors in things like the pharmaceutical industry are large pharmaceutical companies that are publicly owned companies not owned by private equity. And if you are inefficient in the way that you manage these smaller firms, you're never going to be able to sell those firms at a profit at the end, because they're never going to be better than the incumbent actors that would outcompete them. But thirdly, even if you don't believe that this is easily resolved by competition law, don't just be dismissive about this and believe that, well, because there's lobbying, there's no competition law. If a private equity firm really owned all the firms in one market, they would be broken up or would be made to sell some of those assets. No. Next, let's talk about how this impacts lobbying. Firstly, even if you think they have less incentive to specialized firms, diversified PE firms obviously have much more money, and it's very expensive to engage in this kind of lobbying. Secondly, there's no explanation actually of how lobbying works in this speech. They're just like, lobbying is easy. But I guess if you have money, you own the world, right? I don't actually think they mechanize that. They also don't explain why it's bad. Maybe it's good to have deregulation in certain markets. There's not a proper explanation of this here. But thirdly, there's no explanation of why there's a meaningful difference in lobbying before I run out of time.
This provides the critical amount of interest these kinds of firms to bend laws to increase the price of medicine, drive up competition in these sectors, and squeeze every company there even harder to make them do the worst possible practices.
So this is the third response I'm about here. There's no explanation from this team about why this is a meaningful change in the level of lobbying that occurs. Private equity is big. Pharmaceutical companies are fucking massive. Pfizer is already doing enough pharmaceutical lobbying in that industry to get that level of deregulation and influence over government. If you believe money is all that's required in order to exert influence over regulators, that is already occurring in the status quo, and there's no tipping point analysis from this team. The next and final claim they make is that this will centralize private equity money into a small number of safe industries, preventing access to other industries. Firstly, specialized funds aren't crowding out diversified funds. The reason why specialized funds have come to being is as a result of more and more money existing within private equity. So there's still obviously diversified funds that engage in this kind of investment. But secondly, money follows opportunity. If it is profitable for sectors that would, because the argument here is like, well, these sectors would otherwise get private equity and therefore become super efficient and get lots of money and grow as companies. If that is true, a private equity fund will develop because there is profit to be made in that area, as this team concedes by the premise of the impact of their argument, which is that it is meaningful. We give you the largest, most concrete, harmless, better explanation to everything opening government says, and I don't really think anything left from opposition can understand.
Okay, however, I'm going to begin my speech in 3, 2, 1, and I am not a finance law, and the average informed voter probably isn't a finance law. However, there's very clear comparative in top half that you need to understand. Opening government and opening opposition agree that the traditional firms are larger, have more capital to invest, have more ability to invest out. This inherently means that in order for any of this to work, that opening government and opening opposition cases rely on one firm having more capital, more market access, all of that. It is necessary that on our side, firms have more ability to scale up companies. This is the only thing that our extension requires. I will begin by attacking closing government cases directly. First of all of the claim on like finance law have a lot of bad incentives, right? All of the code of personality, stuff like that, sexism, nothing else. I would like you to know, these reasons are also symmetrical to smaller private equity firms, right? That also have people leading the top, that oftentimes start to create code of personality around them, bad incentives within the firm, all of that. Here's the important part. Yael's second extension that we missed, that she says that A, there are oftentimes even more incentives to show specialization and the specialized knowledge within the company, even when it's bullshit. But I would like to add that there are actually more accountability mechanisms to that sort of bullshit underneath our side. Why? Because we have more people that are owning the company and investing in the company, and more people that can call each other out. Large firms oftentimes have multiple people that are treated as gods or whatever that can call each other out, compared to smaller or more specialized firms where one person holds all of the power and controls it. Why is it so important? First of all, the comparative, like the market will solve itself, fails at the point at which all actors in the market are acting bad, right? At the point at which all actors in the market are acting bad, I'm not sure why competition is efficient is going to solve it. But second of all, that is also nullifies the biggest attack that state government has on notice until now. State government says, oh, but you get more specialized knowledge in our side than at you scale. Specialized knowledge is bullshit, right? I'll tell you that directly. Ask the people in 2008, the finance laws and bankers that were selling real estate, how much the specialized knowledge was worth. It's worth bullshit exactly for the reason that closing government gives to us directly. I don't want specialized knowledge, I want capital, I want general principles that work. I think that's way the fuck better than bullshit specialized knowledge that companies invest in themselves, finance laws that don't know shit about the real world, half of them in their own shit. Anyone who's worked for, how did the phrase in the CS debating post recently, that work for a manager but only that doesn't know shit and talks about KPI to the person above them. I really don't think that the specialized knowledge matters. Note also that the rest of the extension are relatively symmetrical to larger firms. Note that larger firms also have all of their externalities, right? Because they control large amounts of the market. When they control large amounts of the market, stuff that they do affects other areas within the market geographically or whatever to a large extent. Therefore, they have an incentive to treat it well in terms of externalities, but also in terms of specialization. And this is also in terms of vision, it's also very important. I feel these firms have sufficient reasons why to do so because they don't want sectors to collapse. They doing multiple suppliers is something which is very obvious, and he just wants to be as good as possible in terms of incentive. Sure, they might have slightly more on their side, but incentive is very good. But on our side specifically, larger firms have more capital to do all of that, right? They have more capacity in order to contract with multiple companies. They have more of an ability to actually do all of that, whereas smaller companies inherently have far less of an ability. And on top of that, I think please, like, I'll take it here, I don't know. Anyways, I think this is sufficient. I want to show you why the majority of the closing government case washes out or is mitigated to a sufficient extent. Why then is our case very, very, very important? No, at the point at which companies can scale more, because they have more capital, they have more people working around, they have more capacity in order to enter that, I think that this means that companies get bigger. Why is companies getting bigger more important than top half? That is continuing to the monopoly clash, as I soon explained there. First of all, even assuming that monopolies exist on one side of the house or the other, I think that simply just the scaling is very times good. Note, Tetris himself already explains to you in his speech why monopolies oftentimes act well, they scale up, and also monopolies do have incentives, for example, to enter new markets and to lower prices because that means that more people are going to buy them, to open up new jobs, to increase wages so that more people will move on to them. I want to specifically talk to you about why this is so important. This upscaling that Tetris has already pointed out as a large effect of large markets. I feel that at the point at which companies scale more, they enter new markets and they lower prices and generally speaking provide more access because it's simply just more profitable to find new artists, to enter new markets, to get more people getting goods. This is simply just far more important than higher prices in already existing markets. Why is that the case? A, access to goods that you didn't have access to before allow you far more basic rights, right? To access healthcare, to access better food, to access better conditions, which are far more basic rights, right? Because even if prices are slightly higher or whatever, then you can still pay them far more, share them far more, and still get your basic rights, whereas without access you don't have anything. Second of all, this means more jobs directly to people that didn't have them beforehand. Not even bad condition factory jobs, this means better than subsistence farming in many different cases. Lastly, this means more taxes for the developing world, countries that hugely need them, right? Already upscaling provides you scale allows you to enter new markets, all of that, way in the most charitable way against the monopoly clash. Second of all, I want to weigh in a slightly less charitable way, but also very important. I think that the majority of topics when talking about monopolies have super small data, right? Because know that both sides of the house have a strong incentive in order to create very, very, very large monopolies to upscale them, because all of that advice for a lot of things. Know that in terms of lobbying, for example, when they talk to you, sure, once I may be able to lobby in slightly better capacity, but both sides of the House have huge amounts of money, have huge amounts of incentive to lobby in order to get control of their own areas. I seriously just think that monopoly is something that every single person who wants to tries to, right? It's something which is ever present in the market, which is very hard to work against, and the majority of firms do so. What is unique on our side? We get scaling. We get the ability in order to actually get that on a far larger scale and to do that. Before I flag specifically, we will also be opening a position and closing out ones.
Private equity firms are likely sufficiently bigger than the firms they own on either side, but if they have access to a good opportunity, they can bring on more investors and get access to more credit to take advantage of it.
Please repeat, Saul.
So private equity firms are probably sufficiently bigger than the firms they're purchasing on either side. But if they're not, and they have access to a really good opportunity, they can bring in more investors or get access to credit so that they're able to do the upscaling you're talking about.
I don't think that is the case. At the point at which the firms are smaller, probably have access to less investors from less areas, because bigger investors can pull in money from investors of several different areas. I think that in the general case, it's a lot harder for you to convince someone to enter you when you're in a different market or from different sectors than they're used to, whereas bigger investments have bigger capital and more ability to do so. Also note, again, second extension, I am unsure why all of these companies notice the good people, have the good ability to do so. I think that relying on far more generalized things or already subsidizing existing companies to scale up is a far more certain and sure pathway to succeed. Lastly, open government. I already POI Carriers explicitly, while he weighs out against monopolies, his case is entirely dependent on monopolies in the status quo because it's dependent on, because if the global market is competitive, then asset splitting doesn't actually occur because other companies will enter in and compete. Therefore, they require monopolization to stand. I am again not a finance for, but I have several structural reasons why the global market is likely competitive. Number one, historically globalization is a very recent thing, so there are likely been very large firms in different areas that have been in the area, right? A big US private equity fund, a big EU private equity fund, and at the point at which they are already big, it's very hard to collapse them because they have a lot of assets that can bounce upwards and succeed. Second of all, it's very likely that countries have A, an interest to protect their own firms and allow them to not collapse, but B, that many international organizations have an interest to ensure that many single firms stand up. Third, investors have an interest that no large private equity firm will dominate the market because then it has monopoly power over investors, right? When one large equity firm control the market, the people supplying the capital towards them get fucked, get lower rates, and get worse ability. Private equity was competitive, also help the people who are investing in these equity firms, and because the people who are investing in private equity firms have an interest to ensure that the market is competitive. Very powerful.
I think that concludes the final speech. All speakers, please cross the board and shake hands and exit the room. We will call you back for the call, hopefully within 20 minutes. All right, while everybody's shaking hands, can we just take 90 seconds to look over our notes? Also, can we turn the screen on? Sorry, skip chat. Sorry, no.